Your credit card has an address. And no, I don't mean the address where the company mails your bill. I mean a legal address, one that could be hundreds or even thousands of miles away from you. You might live in California, shop in Texas, and pay your bill from an apartment in New York. But the rules behind your interest rate? Those could come from South Dakota. Sounds random, right? It isn't. That strange detail helps explain why a completely ordinary credit card can charge more than 20% interest today, even though rates like that were once illegal across much of America. And this didn't happen because voters suddenly demanded more expensive debt. There wasn't one giant law called, "Let banks charge whatever they want." Nothing that obvious. Instead, the system changed through a chain of events that almost nobody noticed. An old law written during the Civil War, a Supreme Court battle between two banks, an inflation crisis, and a struggling state that needed jobs, fast. Put those pieces together and you get the credit card system Americans live with today. So, how did your interest rate end up with an address of its own? Let's follow the money. For most of history, societies treated high-interest lending as something dangerous, and the reason was pretty simple. When someone desperately needs money, they don't have much bargaining power. They might need food, medicine, rent, or enough cash to survive until payday. The lender, meanwhile, controls the thing they need. That relationship can become exploitative very quickly. So ancient civilizations created limits, religious traditions warned against excessive interest, and eventually American states established their own usury laws. Usury basically means charging interest that's illegally high. For generations, these laws worked like guardrails. A lender could still make money, but there was a ceiling, a line it wasn't supposed to cross. In many early American states, permitted rates stayed in the single digits, and the punishment for breaking the rules could be brutal. Some lenders risked losing the interest. Others could lose the entire loan. Yes, even the original amount they handed over. The message was clear. Make a fair profit if you want, but don't build your business around someone else's desperation. Now jump forward to the 1860s. America was fighting the Civil War, and the federal government needed an enormous amount of money. The banking system was fragmented, so Congress created a national banking framework. Inside that framework was a rule about interest. A nationally chartered bank could generally charge the rate permitted by the state where that bank was located. At the time, this made perfect sense. Banking was local. A bank in Ohio mainly served people in Ohio. A bank in Nebraska mainly served people in Nebraska. There were no online applications, no nationwide card networks, no instant approvals, and definitely no app offering you a credit line before breakfast. The idea that a bank in one state might serve millions of customers across the country would have sounded like science fiction. So that rule sat quietly for more than a century. Then technology changed the game. By the 1970s, banks could market credit cards across state lines. A company could mail an offer to someone living far from any physical branch. Suddenly, an important question appeared. If the customer lives in one state and the bank is located in another, which state's interest limit applies? The customer's law or the bank's law? That question reached the Supreme Court in a case called Marquette National Bank versus First of Omaha. Yeah, the name sounds boring, but stay with me, because this dry banking dispute helped reshape everyday life in America. First National Bank of Omaha was based in Nebraska, but it offered credit cards to people in Minnesota. Minnesota had stricter interest limits. Nebraska allowed the bank to charge more. A Minnesota bank argued that if Omaha wanted to lend to Minnesota residents, it should follow Minnesota's rules. Seems logical, doesn't it? The Supreme Court saw it differently. In 1978, the court ruled that the nationally chartered Nebraska bank could use the interest rate allowed in Nebraska, even when its cardholder lived in Minnesota. And right there, the meaning of a bank's location changed. An address wasn't just an office anymore. It became a financial advantage. Think about what that meant. A state could pass strong laws protecting its residents from high interest, but an out-of-state national bank could potentially lend to those same residents while using the rules from its own home state. The customer stayed where they were. The bank's law traveled across the border. But one court decision alone wasn't enough to transform the entire industry. The system still needed pressure, and that pressure arrived through an economic crisis. By the end of the 1970s, inflation was tearing through the American economy. Prices jumped, paychecks lost purchasing power, and interest rates climbed to extraordinary levels as the Federal Reserve fought to bring inflation under control. This created a serious problem for banks. They had to pay extremely high rates to get money, but in states with strict usury limits, they couldn't always charge borrowers enough to cover those costs. Imagine buying something for $20 and being legally required to sell it for $12. You wouldn't lose money occasionally, you'd lose money every single time. That was the kind of pressure facing major credit card operations. Citibank was especially exposed. Its credit card business was connected to New York, where state limits made the economics increasingly painful. The bank wanted New York lawmakers to raise the ceiling. But think about the timing. Americans were already angry about inflation. Food cost more, gas cost more, homes were harder to finance. What politician wanted to stand in front of voters and say, "Good news, we're letting credit card companies charge you more too"? So Citibank began looking for another solution, another state. And that search led to South Dakota. At the time, South Dakota was struggling economically. Communities were under pressure. The state needed investment. It needed businesses. Most of all, it needed jobs. South Dakota had also moved to eliminate its interest rate ceiling for regulated lenders. Then Citibank arrived with an offer. The bank would establish a credit card operation in the state. South Dakota would get hundreds of jobs and a new financial industry. Citibank would get something equally valuable, a home state without a restrictive interest cap. It was a deal both sides could defend. South Dakota could say it was creating employment. Citibank could say it was saving a business that had become unsustainable. But the effects wouldn't remain in South Dakota, because after the 1978 Supreme Court ruling, a card issued from there could be offered nationwide using South Dakota's permissive rules. That's the twist. Citibank didn't need its customers to move. Only the legal home of its credit card business had to move. Suddenly, a state with a relatively small population could shape the interest rates paid by people across the entire country. And once other states saw what South Dakota had attracted, the competition began. Delaware moved to make itself appealing to financial companies. Other states relaxed their own rules or created bank-friendly environments. It became a race. Keep strict limits and risk losing banking jobs, or loosen the rules and invite companies in. For each state, the decision could look perfectly rational. The jobs were local. The offices were local. The economic activity was local. But many of the borrowers paying the interest lived somewhere else. In other words, a state could keep the benefits close while spreading the costs across the country. Then Washington expanded the system. In 1980, Congress passed a major banking law that extended similar rate exporting abilities to many state-chartered, federally insured banks. This was important. The Supreme Court case had focused on national banks. Now, the same basic advantage could reach far more of the industry. But wait, interest rates weren't the only source of revenue. What about late fees, annual fees, cash advance charges? Could a state still protect its residents from those? That question eventually reached the Supreme Court, too. In a 1996 case involving Citibank and a California cardholder, the court accepted a broad interpretation of the word interest. Under that interpretation, certain fees connected to credit could travel under the issuing bank's home state rules as well. First, the interest rate crossed state lines. Then, many of the fees came with it. And that brings us to the part of this story that's easy to miss. There probably wasn't one secret meeting where powerful people designed the entire modern credit card system. The truth may be more unsettling than that. Congress was trying to organize banking during a war. The Supreme Court interpreted the language already written into federal law. Banks were trying to survive an economic emergency. South Dakota wanted jobs. Other states didn't want to lose those jobs. Every decision had its own logic. But together, those decisions created a system in which the strictest consumer law doesn't necessarily win. The most exportable law does. And once that happened, the credit card business changed. A customer who pays the balance in full can generate transaction revenue. But a customer who carries a balance month after month may generate interest for years. Now, imagine someone puts a $2,000 emergency expense on a card. Maybe their car breaks down. Maybe the refrigerator dies. Maybe there's a medical bill insurance didn't fully cover.
They intend to pay it off quickly.
Then rent increases, work hours get cut, another emergency hits, so they make the minimum payment. The balance barely moves. Interest arrives, then more interest. At some point, they're no longer paying for the original emergency. They're paying for time. That's what revolving debt really sells. Time today in exchange for more money tomorrow. And the higher the rate, the more expensive tomorrow becomes. So the next time you open a credit card statement, look beyond the purchases. That interest charge has a history. Behind it is a law written during the Civil War, a court ruling from the 1970s, an economic crisis that pushed banks toward the edge, and a competition between states for jobs and investment. Your card may fit in your pocket, but the system behind it stretches across centuries. And the most powerful feature isn't the chip. It isn't the spending limit. It isn't even the card number. It's the invisible law attached to the bank's address. Because you can cut up the plastic, but as long as the balance remains, that invisible law keeps working, and it never forgets to charge interest.